Hello and welcome to interest.co.nz. I'm Jason Walls and I'm joined by Stephen Toplis, who is the Head of Research at BNZ, and we're here to have a conversation about New Zealand's economy and just some of the things that BNZ sees, and Mr. Toplis himself as well. So firstly, you guys issued quite a popular note that came out earlier this week on New Zealand's economy, and one of the things you were talking about is that New Zealand is threatening to move into this pseudo-inflation environment. What is a pseudo-inflation environment?
Pseudo-stagflation.
Pseudo-stagflation,
yeah. So the reason we said pseudo is in the good old days, I guess, when you talked about stagflation, you were talking like minus 1% growth and 10% inflation. Now, clearly we're not going to get that sort of environment anymore. But what we're talking about is having difficulty with inflation, i.e. it's hitting the top of the Reserve Bank's target range, and at the same time having growth that's below trend. So it feels to us we're moving into that sort of environment.
And what does that mean for the economy, or what does it mean for just your average Joe blog to be in stagflation?
For the average person, I don't think it's going to matter too much. In fact, it's almost a nice position to be in. We've got growth, not spectacular, but probably almost as strong as the economy can cope with. We've got inflation, but it's not exceptional inflation. So at the margin, perhaps a little bit negative because prices are going up a bit more than the average punter would like. But by and large, it's nothing to be afraid of.
And how does this differ with the Reserve Bank's perception?
Yeah, I guess the single biggest difference we have is we think we have more inflationary pressure in the economy. The central bank has a more optimistic growth forecast than we do, and ironically a lower inflation forecast accompanying that. We think that's because there's greater capacity constraints in the economy than the central bank recognises, and so that it's capacity constraints that will slow down economic growth and capacity constraints that will generate that extra bit of inflation. But let's face it, what's the difference in opinion? It's not like chalk and cheese, we're talking about stuff at the margin here.
And just on your growth expectations, the Reserve Bank, although they did wind it down just a touch, it was still quite rosy and keeping up at the high levels. Do you think that they're being a little bit too optimistic with their forecasts?
Yeah, we think they're being optimistic, but optimistic in a medium-term sense. So in the next couple of quarters, we've actually got stronger growth than the central bank. But they've assumed by and large that the big fiscal stimulus that we've seen, accompanied by the impact of relatively low interest rates, would drive quite a big economic expansion next year. We're just not quite so convinced that that's going to happen.
Why is that?
Well, the first thing is that the fiscal stimulus is being swamped by a number of other factors. First, on the supply side, we're seeing migration fall away relatively aggressively, and that's slowing down the impetus from population growth. We're seeing commodity prices come off their peak. We're seeing a housing market that's basically stuck in the mud. We're seeing tourism growth starting to abate, so all of those things are pushing against it. And at the same time, those capacity constraints are really becoming quite binding. Then we've got the fiscal easing that's hitting the economy, and we initially allowed quite a big impact for that. But what we get the feeling is that there's substantial cost rises also facing the very same people that are getting the fiscal stimulus, and that's sort of eroding the impact of it. And the classic example of that is petrol prices, where we're seeing a substantial increase, and people can't avoid those petrol price increases. They have to travel, so that's eroding the gains.
So on the one side, you've got this massive fiscal stimulus by the government, that's the families package, the provincial growth fund and things like that, but you're saying that that is going to be, in a large part, offset by the other increased costs in the economy?
In part, yeah, and by capacity constraints themselves. I mean, one of the biggest problems that we've got is we need all this new infrastructure, we need all the new housing, but we can't put it in place in the next 12 months because there just simply are not enough people or resources to do it.
So what's the answer to that dilemma then? What does the government need to be doing?
Well, I'm not sure there's any immediate answer. I mean, it's a matter of being patient, not trying to do everything at once because the capacity constraints that we've got won't allow it. And apart from that, it's a case of same old for government, and that's to try and remove as many impediments to growth as you can and just not get in the way.
And also in that note, you talked about government debt, and you said that you don't think they'll be able to meet the 20% to debt GDP ratio. What's your reasoning behind this?
Yeah, twofold. In the first instance, we know that economic growth is coming in below what Treasury expected. So that will tend to drive revenue, and so softer growth, softer revenue. Now, it's possible that higher inflation might offset that, and you get the money through higher inflation rather than higher growth, but we don't think it's sufficient to offset it. So you've got a slower revenue increase. On the flip side, everyone is asking for their pound of salt from the government. So everyone's out there with their hands out saying we want more, and it's going to be very, very difficult for the government to completely resist that, particularly as we get closer and closer to the end of another election cycle. So we're not talking about a collapse in revenue or them getting ridiculous in terms of their spending, but what we do know is that government surpluses or deficits are the difference between two very, very big numbers. So if your revenue flows fall by just a smidgen and your expenditure goes up by just a smidgen, then the deficit can move by quite a lot, and in turn that feeds through into the debt figures.
So if they did have to or they didn't meet that debt limit that they have, what would be the economic impact on that for New Zealand? Would there be any serious repercussions?
Frankly, I don't think it matters. What we tend to talk about this sort of 20% of GDP as if it's sacrosanct. I don't know any economic research anywhere that says that 20% is the magical number that you should go for. It's just a target, that the government has set out for itself, and the main reason for that target is to show that they're being fiscally responsible. So the number itself doesn't matter. So if for argument's sake it went up to 22% or 23%, it doesn't really matter a whole hell of a lot. What would matter is if it started to trend higher and looked like it was inescapably going to go 25, 30, 35,
right.
then you'd see quite a significant market reaction. And I guess the number is a bit of a red herring. What we should be talking about is the quality of the expenditure and the quality and appropriateness of the revenue flows rather than the magnitude of them.
And on the Kiwi dollar, we saw that come off quite markedly after the Reserve Bank had that quite dovish, and you called it Australianly dovish, statement last week. How much further do you think that it has to fall against the US dollar from now?
Yeah, I'd hate to guess. And part of the problem is the starting point is we don't know yet, because the markets are still digesting the change in view of the central bank. We don't know whether they've possibly overreacted a little bit, and so you might see some reversal of that. The other thing is, of course, that while the central bank in New Zealand basically started the process of the currency falling over the last few days, along came Turkey at the end of it, and people sold off just about every peripheral currency on the planet. New Zealand dollar is one of those currencies, and so there's an element there too of a little bit of fear, perhaps overdone. So it's hard to know whether we're at a stable starting point in the first place. So the potential for a bit of a bounce somewhere along the way is quite high. Having said that, I think that perhaps a better way of looking at it, rather than looking at a number, is to say that the factors or the reasons why people bought the New Zealand dollar are basically gone. We bought it because we had an interest rate differential in our favour. We bought it because commodity prices were rising. People bought it because New Zealand's general growth outlook looked fantastic relative to the rest of the world. We bought it because there was an absolute sense of policy certainty. Now all of those things aren't there anymore. So it's more a case of not people selling the currency because they don't like it, it's just there's no reason to buy it anymore. So we think the pressure on the currency continues to be downward, but not exceptionally so because there's no disaster limit.
But we're not going to see it jump back up again to above 70 or around about that levels because the fundamentals have all been drawn away?
You never say never, but it seems highly unlikely.
Seems like a good place to leave it. Thank you very much for joining me, and thank you very much for watching.